Are you someone who is curious to see the direct head-to-head comparison between BIGY and HHIS? Those are two community favorites after all. If not, then hopefully maybe some chatter about cover call ETF tax examples. If not that, maybe some sector by sector comparisons. Hey, if not that, then maybe you are curious about some distribution changes over lifetime versus month over month. Because in today's video, what I want to do is talk about the top 10 must-see high-yielding dividend ETF facts for monthly income. So without wasting any more time, let's go. Okay, so for the very first thing we're going to be looking at here is HHIS versus BIGY. These are two community favorites. They are in direct competition with one another. One by Harvest, which is HHIS. One by Evolve, which is BIGY. What makes these two funds insanely popular? Could it be the yield? Of course it's the yield. In this case, you got basically two funds that invest in concentration in some of the biggest companies in the U.S. We're talking the Nvidias, the Strategy, Coinbase, Amazon, Netflix, basically the Mag 7, the FANG stocks, if you will. Okay, so let's just look at, go through the cover call ETF AllStar tracker. This is, again, a Google Sheet I've created that you all can access for yourself. But I'll chat a little bit more about that later as we look through the tracker. In this comparison, I've also added the Qs, right? The SPY and the Qs as our index proxies, just as a comparison. So right away, HHIS, which now has 20 holdings within it, it's an all-in-one for 20 single stock cover call ETFs by Harvest. BIGY doesn't do that. It just picks 10 stocks. So you get more concentration. And with HHIS, you get about 25% leverage, BIGY 33%. But as we go along here, we see in Canada, wow, I mean, HHIS has some really big volume. In Canada, that's big volume. BIGY hasn't been around as long. HHIS been around for maybe, since the beginning of the year, BIGY September. So hasn't been around as long, but again, it's a direct competition with one another. All right, so when it comes to performance, let's just look at the first little bit here. We see that the tech-heavy NASDAQ up for the year, total return is 23.13%. The S&P 500 total return is up 17% for the year. And then we got HHIS total return up 29.72% for the year. And BIGY only been around for a little bit here, up 9.46%. So I mean, the comparison on price might not be as fair, but it just goes to show you these are two funds that are heavy hitters, right? They are looking at what is the maximum potential yield that it can pay out, or what's the maximum potential as far as yield is concerned, and along with price appreciation as well. So that's why these two funds are especially popular. One other kind of neat fact about BIGY is it pays out twice a month, which is a rarity here in Canada. It's much more common in the US to get weekly payers. But up here in Canada, there's maybe 3 funds by Hamilton that pay twice a month, and Evolve's BIGY is the other one that does that. HHIS monthly. As far as fees are concerned, these two fees are probably, I would say around 30% lower than the average of what active management involving cover call ETFs are usually at. Usually 65 basis points. If you're not familiar with that language, that's 0.65% for a management fee. So considerably lower than what it's typically been in the past. And hey, more competition is only going to lead to, ideally, a lower cost on management fees there. As far as portfolio coverage is concerned, this is an important metric. This is what is used to determine how much on the portfolio call options are going to be written on. So at 50%, that means the other 50% of the portfolio is totally unbound. It can grow without the fear of being capped on the upside, which covered calls are known for. So they both employ a similar strategy in that regard, which I'm happy with. I like the fact that a lot of these funds, especially up here in Canada, they're hybrid approaches. And so you basically get, I'm 100% in cover call ETFs, but really when I look at it, I really do look at, I call it half my portfolio, just participates as the underlying asset does. And there is no, fear of capping upside. I have full participation on half of my portfolio. Now, when it comes to AUM, HHIS has rocketed past $1 billion in such a short period of time. There's other billion-dollar players in the cover call ETF landscape here in Canada, but HHIS just struck a chord with everybody. And I know, again, BIGY, I know for Evolve, this fund, I think it was 40 or 41 days it passed $100 million. And for Evolve, that was their quickest ETF to reach $100 million. Okay, let's just go along to monthly changes in distributions. There's going to be nothing from BIGY because it has just been released at time of recording. But HHIS recently just added, I believe, Circle and Reddit and Robinhood. And I think there was a SoFi. So they added a couple more funds. And those are higher yielders, which allowed Harvest to bump it up slightly from 25 cents a month all the way to 26, a 4% increase to get the yield up slightly more. And as of right now, it's at 22.25%. All right, moving on to our next topic, which is going to be monthly distribution changes from October over to November for Canadian cover call ETFs. And once again, everybody, if you like this video, be sure to subscribe, like the video. If you want to see maybe an American version of this inside the tracker, just let me know in the comments. By the way, insanely important you guys participate in the comments. I actually find it, and I know other people do as well, if there's something missed or you need to add context, be sure to put something in there so that other people can read it and learn. It is very helpful. Now, as far as month-over-month changes are concerned, this is actually a pretty active month. Having worked on this tracker for almost 2 years now, I gotta say this is one of the busiest months for distribution increases. Now, from the tickers that I see over here, Global X has been incredibly active. And you got a mix of Harvest, a little bit of so I would say the big players are Global X, Harvest, a lot of the single stock stuff. Good to see that the Bitcoin miners one has seen just a tremendous increase with that 30.3%. You also have from Global X their gold fund, like a boring, insanely boring gold fund. That's not gold miners. It's just holding gold with cover calls on it, and even that one has risen 33.33%. But before you want to get into that, just understand that one's it yields somewhere under 10%. I want to say it's like 8.5. What else do we got here? Some single stocks, Palantir. We have this is where we actually have a gold miners one, which is GLCC, up 25%. Gold has been on a tremendous run this year. Hey, maybe I would have bucked a bit of disdain for gold earlier this year if I knew if I had that crystal ball and I knew what it was going to do. But alas, none of us do. So that gets a 25% increase. Also, too, hey, you know what? Out of left field here, we get the Russell 2000 gets a 15% distribution increase month over month. I didn't really see that one coming. Again, GLCC, the 25% leveraged version, GLCL, that one's up 12.5%. Then, of course, you got what is that one? Emerging markets. You got the developed markets. leveraged versions, emerging markets unleveraged, and again some other funds by Global X, right, like QQCC and its 25% leverage version, QQCL. Which one? What is that at? 6.78%. Nice little increase. I own that fund, so hey, that's good for me here as well. And let's not forget about Hamilton here. They're kind of rounding out the bottom of the changes. Typically, what this column usually looks like month over month, there's a little bit of green at the top, but for the most part, it's all like 0%. It's just nothing has changed. But I think over the last little bit here, we've seen the stock market doing really well. Typically, if things have been going really well and they're steady, that gives at least in part the fund managers a little bit of breathing room to raise distributions a little bit. There is more to it than that, like volatility, a whole host of other factors. However, that's why I do root for up markets, because you get a natural pay raise. Never a guarantee, but I do usually have confidence, and I've seen this on a year-to-year basis that good markets allow for these distribution increases. So HYLD, I own that, gets a 4.08% increase. HDIV, an unsung hero of the cover call ETF space. It really is the fund that kickstarted the modernization here in Canada with the 25% leverage on cover calls, and especially focusing. It does have a bit of a unique mix. It's about 75% Canadian, 25% American, and of course HHIS gets that 4% increase. Even this Global X Telecoms one, very surprising, gets a 3.2824%. Don't exactly have my eye on this one in particular. I'm kind of more of I'm a utilities guy, so I don't mind if a few telecoms are kind of batched into a fund with utilities, but an all-out telecom fund, haven't really been paying attention to it, but nonetheless, it gets a 3.24% increase. And then, hey, look, rounding out the bottom, we get a couple new funds by by Hamilton. Q-Day and S-Day also getting a little bit of an increase as well, 1%, and a little bit under that as well for the other Hamilton fund. So those are the increases. I'll go through the list here so you can just see that typically it's just 0%. A lot of Canadian funds opt for stable distributions. So normally pretty boring, but at least this month a little bit more exciting to talk about. Who has decreased distributions? C-Day, I don't know. Who's got the biggest ones? MSTE, so shouldn't be surprised there. Bonds are horrid. I'm not a fan of fixed income. Never have been, and I haven't been shy about sharing my thoughts on fixed income. So HPYT once was a darling in the income community, but for a short while, and then it kind of fell out of favor once people kind of saw that it's not naturally, it just doesn't have that lift, that rocket fuel to kind of help it out on the price appreciation side of things. So anyways, bonds getting a little bit of a hit there. And yeah, bonds and basically micro strategies, more bonds, a little bit of energy. The one utility fund down ever so. That's the thing with Hamilton, with their maximizer suite. So you'll see utility maximizer, a couple maximizer here's. You're always going to see with that lineup a little bit of an increase every month, because they do slightly adjust. And so you'll see a little bit of a decrease and a little bit of an increase from funds. So you're always going to see Hamilton's products in the tracker on the top and the bottom end as well. So the third fact I wanted to look at was taking advantage of income ETFs that have a play on Bitcoin, or have a play on companies that are technology companies that are integrating Bitcoin and blockchain technologies. So if you're up on more on that stuff, unlike me, then there could be a play there. So I wanted to highlight the relationship between the two, because both have gone in I wouldn't say opposite directions, but one's been trailing the other by a wide margin. So here we got in purple IBIT, which is an ETF that just tracks Bitcoin. There is no cover call on IBIT. HBTE, on the other hand, is a fund by Harvest that focuses on said technologies that employ blockchain technology, Bitcoin mining, etc., and has about 25% leverage with it. Well, total return to date, one's up, HBTE is up 142%, where IBIT's up 14%. And price-wise, HBTE is up, as of time of recording, 123%. What is going on here? I mean, I know I'm not Bitcoin savvy. Many of you who follow my channel a while know I don't invest in Bitcoin. I have appreciation for what Bitcoin's trying to do. I do. But this is a fascinating trend. What is going on here? I mean, if you have a better idea than me, make sure to put that in the comments, and especially for others to read that as well. To me, it looks like, and I've been paying attention more closely to Bitcoin than I ever have been. It's been trading at like 110 to 125 for what seems like the past 6 months. Meanwhile, if there is hype towards Bitcoin, it seems like that hype is jumping into the technology companies, ones that can provide a guidance outlook and quarterly reports. And there's a better understanding of how to maybe measure that. And maybe there's just more excitement with the companies versus Bitcoin in of itself. I mean, as far as I'm told, Bitcoin's supposed to go to like $1 million. So, if it goes to 130, 140, I don't exactly feel like I'm missing out. And if it's just going to trade sideways like it has been for a while, maybe I'll dip my toes into it at that point. Or maybe just go more for the HBTEs of the world. Where people seem to be much more interested in what the technology companies are doing. But I think that is a fascinating observation to see what the difference is between these two. Bitcoin really hasn't participated in such an incredible year like we're having here in 2025. No, a lot of that Bitcoin excitement has been flowing through into the companies themselves. For our fourth set of facts that we're going to be looking at is the top AUM dogs in the Canadian covered call ETF space. But before I do that, I want to make a specific and special plug for the tracker. Right now, I got an end of year sale going on. For $50, you can have updated trackers emailed to you on the first of every month until March of 2027. That's like a small Starbucks tall latte that you can replace that with like once a month. That's the equivalent. Okay. And not only that, but you are getting access to all the information from 300 plus funds across Canada and the US, resource tabs with introductory videos, tutorial videos, tools that I use or have used. You want to see my portfolio? It's all there for you. You want to see my trades? It's all there for you. You want to see my various buys, my sells, my contributions, my dividends? It's all there. It's all transparent for you all to see. I got nothing to hide. Trust me, it's like there's nothing to hide when it comes to any of this stuff. Maybe you want to look at Canadian taxes. In the new year, I'm going to do American taxes as a massive update come the new year. Distribution history, average volume, if you're interested in that. AUM history, month over month, see the changes there. Yield history. Distribution history, it's all there. There's so much stuff. I created this tracker to solve one specific problem, which is combining information on fund manager website, information from Google Finance in one location. I wanted to make a product that would be easy to use, that you could filter, that once you actually kind of get the hang of it, you can build mock portfolios for yourself and see what the averages are against like other indexes like the S&P 500 or the NASDAQ 100. And trust me, I'm not someone who is ever going to ask you guys for a tip or a handout. If you like my channel, please, think of giving. I will never do that. Not once. My character is not geared towards that kind of stuff. I want to build amazing things for you guys to help you with your financial education so you can manage your own portfolios. And if you find interest in the cover call ETF space, then this is a product for you. So hopefully that's a deserved pitch to get you into the tracker and get you researching for yourself. Because I'm telling you, for me personally, from someone who knew nothing before age 30 on finance, learning about education and my finances have kind of, right, I've pulled my finances along with me with the more education I have. This tracker is meant to be a spot that's easy to use. Do you really want to build like a portfolio or the spreadsheets like this for yourself? I can guarantee it's not going to happen. This thing takes a lot of time to not just build, but kept updated as well. All right, with that being said, let's get into the AUM stuff. At the top of the heap here, we have BMO. They have 5 of the 8 funds in the $1 billion club here in Canada, which is great. 2 from Harvest, 1 from Hamilton. BMO was first on the scene in the 2010s with the cover call ETFs. Now, I would say that these cover calls are built in such a way for advisors and retail as well. Basically, the more time I've spent with the professionals, the more little tidbits and insights I get into when it comes to fund construction. And funds like BMO's are certainly much more geared for advisors as well. Not just any advisors, their own advisors or their own product sales teams. People that sell, like, when I think of people who sell stuff at branches, like you think of people who sell mutual funds. Well, it could be something like that. Now, full disclosure, I've never spoken to anybody at BMO, so I really don't know how the absolute inner workings work, but it's just you spend a little bit more time in this industry around the people who manage these funds. You kind of get to kind of hear some stuff about what's going on behind the scenes. So, yeah, as far as I'm concerned, yeah, BMO might be the AUM kings of cover call ETFs, but you know what? I think over time, they're not going to stay there. I think other funds will eventually, it's just a matter of time before other funds eventually catch up. Now, there are some funds here like ZWB, man, that's going to be a tough one to absolutely to capture. But you have funds like HHIS that have been around for under a year. People are in love with this fund. It's the fund that we all never knew we wanted. It's sort of the iPhone of cover call funds. Like, you think of that Steve Jobs announcement of the iPhone back in 2007. And we all never knew we needed an iPhone until we finally got one in our hands. And then that's what HHIS is. It's basically offering 20% plus yields, leverage, with market participation in there as well. It hits the best of both worlds, a diversified fund with 20 companies inside of it. So from that standpoint, that's why it has attracted the love that it does in the community. Of course, another Harvest fund, HHL, it's been around for a while, basically the top healthcare fund. And then rounding out, we got, what is that? HMAX, which I would say HMAX is the top. It's the top modern fund, right? It came out in a time of the modernization of cover call ETFs, where funds started to employ leverage, steady distributions, making tweaks to the strategies to make them a little bit more different than, say, the other guys. So HMAX definitely doing really well there. And actually, you know what? Hamilton, with their Maximizer suite, is another, I would say it's another block of funds that are competing for advisors. Now, the only problem for Hamilton is they don't have the same kind of brick and mortar infrastructure that BMO does, right? Hundreds of branches, maybe thousands of branches. I have no idea. But they have a leg up with history, and of course, they are so ingrained into the Canadian psyche that it's almost hard to run across someone who hasn't heard of BMO. Like, everybody's heard of BMO. In the community, everyone's heard of BMO and Hamilton. Like, those are mainstays. But if you want to think about like blocks of AUM like that BMO has here, well, look at what Hamilton is doing with some of their funds. You got 4 funds here reaching almost $1 billion. They have their HMAX fund, the Maximizer. This is part of their Maximizer suite. Maximizer. You have their all-in-ones, which include their Maximizer suites. And so this is like the next block of funds that don't employ leverage except for the all-in-ones, HDIV and HYLD, right? So these funds you would see inside of these two. All right, so 2 funds by Hamilton with the 25% leverage. Their maximizer suite does not have leverage, but you can see another block encroaching up on BMO. Smart strategy by Hamilton, I would say. Have one fund with leverage where we can put all this stuff into one place, and or we could just keep it separate and let the retail choose. We can also use this for advisors as well. Basically, as far as I understand, advisors do not love leverage. That's like dropping an F-bomb in the middle of a library. Right? It's like shock value to the advisors. They do not want to touch leverage. From my understanding, from the more of the events I've gone to and talking to more of the professionals. So Hamilton playing both sides of the field here when it comes to how they are marketing this to everybody else. So you're going to see some more $1 billion players coming up here pretty quick. But for our 5th set of facts, I want to look at management fees and just chat a little bit more about the evolution of management fees, and also give you all some context around management fees, especially if you're newer to this. But ever since I started investing in covered call ETFs back in early 2022, the management fees on average were around 65 basis points, so 65%. Now you might see 0% and think, hallelujah, these things are cheap. How do they do this? They're just giving these funds away for free. That's obviously not the case. Usually if it's cheaper, there's something else going on behind the scenes. So I wanted to help give some context to that. If you see 0%, typically this might be because there's a promotion going on where they're just waiving the fee for a set period of time, or maybe in their case, for a lot of these funds like HDIV, BMAX, HHLE, they are ETFs that hold other ETFs inside of them, whether it be single stocks or sector ETFs. They hold other ETFs. So those underlying ETFs charge the management fee. The umbrella ETF that holds them does not charge it. There is no double dipping. Now, as far as legitimate funds that pay the smallest amount of, or you would have to pay the smallest amount of fee for, that's going to be these Harvest funds. Now, right now they are 9 Point is newer to the covered call ETF game. But they have a suite, the high shares lineup, that it has a fee waiver of 0% until February 2026. And then after that, it's going to be 0.29%, which is incredible. These active management strategies have across the board, not just 9 Point, but they've all been coming down a little bit more time and time again. And so at 29 basis points for active management that's a phenomenal number. So don't necessarily get too I would say focused on management fees. They are coming down. There's just so much competition, and it's making these things a lot cheaper. Just keep in mind that there's management fees, and then there's like the MER, which is management expense ratio. This is that captures all the costs associated with running the fund. So to pay the manager, it might be 29 basis points. But then if it uses leverage, you got to pay for the interest costs, which, by the way, a lot of these fund managers can get interest rates at a much cheaper price than we do. So if you get 4.5% on a loan, they might get for these funds, maybe they get like 2%. I've never heard the exact numbers from any of them, but I know that they get discounts for the kind of money that they're wanting to spend. So active management, again, getting cheaper. And of course, there's marketing costs and custodial costs, and sometimes trading costs get wedged in there as well, but sometimes that's separate. But anyways, 9 Point's will be the ones to have the smallest amount of management fees that you pay for. Of course, they use leverage, so you'll end up paying for that. But as far as management fees are concerned, they are going to be the ones to compete with if you want to say like, hey, our suite of funds has the smallest active management in Canada as far as a suite is concerned. There's other one like outliers, like say EMCL here. This is a leverage fund that holds another fund where again you pay for the underlying ETF cost, but then they add on a small little extra just because maybe it's a leverage fund. I don't know what's going on there. But anyway, but you can kind of see here a lot of 0.35, 0.39, a lot of 0.4. This would be a lot of Harvest, and a lot of Evolve is going to be in this 0.4 range. So anyway, again, a lot of the newer funds, they're competing. And you see it especially in this 0.4 range. That I guess seems to be the new average as far as modern funds. The ones we kind of now innately think about is probably 0.4. That's probably more the average. So that means the average, you can maybe think about it coming down like 35%, with 0.4 being the new average. For fact number 6, we're going to be looking at an example of how to use the tracker to get some idea of what you might pay for taxes. Now, of course, always consult your professional tax advisor on this. This is for general purposes, get you within just to think about it in a ballpark sense. So for this example, we're going to use my own taxable account, which is a marginal tax account. So what I'm going to do here is filter this by 3 funds that actually have some tax factor summaries to them. So we got ENCL, we're going to do UTS, and to finalize it, we're going to use bank. We're just going to use these 3 funds, okay? Of course, I've broken this down numerically, but you can also see it as a percentage as well. Now, I know this might look like craziness to those who are brand new. It'll come in time, but again, you just got to get with the language and come back video after video, whether it be my channel or somebody else's. Okay, so those are the 3 funds we're going to look at. Let's go back over to my portfolio here. Let's filter by, let's get rid of these ones. We only want to look at the margin account. Of course, I got HHIS in there. I got to get rid of that because that's a newer fund and it doesn't have any tax factor summaries to it. So there we go. We got, whoa, that was a little too far. So how much money have I made this year from these 3 funds in my taxable account? Well, I've made a grand total of $4,131. So we're going to use that as our basis to see how much I would pay in taxes. Now, I'm not going to do RSPs. I'm not going to factor in. I just want to know what it would cost, okay, in the simplest form possible. Now, I'm going to link this in the description below. This is the WealthSimple Tax Calculator. So I've already gone ahead and put in some of the numbers here. I live in British Columbia. My income isn't $100,000, but I'm just using that as an example. So with $100,000 and basically just with nothing else contributed, no RSPs, nothing. That's all I've made. I would pay $24,589. So let's just remember that number, $24,589. So we want to go down to capital gains and we want to fill in that number. So again, when it comes to filling that in, we've made $4,131. Now, again, this is going to be kind of ballpark-ish just to get through the video. A lot of it's been return of capitals, which means a lot of it is just delayed capital gains. I won't be paying much tax on any of this. Nothing really I need to worry about. Now, as far as a percentage, let think of it whether it's percentage or points. Like this, if we think of 3 funds, we think of percentages, it should all total about 300%. And so what do we have here? We have roughly 225%. So over 2/3, well over 2/3. Well, you know what I'm going to call that? I might just call that 75%. 75% is return of capital. I know I'm making generalizations, but I'm just trying to do this just to get through it quickly. Okay, so roughly 75% of it, I'm not paying taxes on. It's delayed capital gains taxes on. So as far as this is concerned, capital gains, the sum is, we'll call that, what should we call that? 57. We'll call that maybe 20%, roughly. Something like that. I think I'm just going to call that 20%. So if I go back to my number over here, 25% of, like, and again, I'm just doing this off the top of my head. It's like $1,000. Okay, so I'll plug that in here, and I'll be even extra generous. I'll say 1,100 in capital gains. There was a little bit more when it came to eligible dividends. I want to say, yeah, we got some eligible dividends in there. So that's, yeah, I mean, I didn't really need to go to this, but 17%, yeah, we'll just call it 5%. So I would probably say that that's going to be, I'm going to put a little bit more in here just to make it a little bit more even. So for eligible dividends, maybe we put, just for the sake of it, I'm just going to put $400 in it. Now I would say of taxable, like the taxableness of this is probably already a little bit higher. So now we're paying $24,781. So just remember that 24, so 781, if we eliminate it, 781, that gets us to basically what, $208 in taxes I'd pay roughly on whatever that was, $4,131, right? There we go. So on that amount there, because most of it is ROC, return of capital, a tax designation and cover call ETFs often employ a return of capital strategy into the fund. 75% of it is delayed capital gains. So either when I sell it, or I know it's a lot of info. It's a lot of like terminology, ACB, adjusted cost base. Once that runs down to zero, then any year following after that. Usually that only happens like 7-10 years after holding the fund. Then you start actually paying capital gains on that ROC. So in time, just understand, in time, you would pay capital gains on this if you never sold these funds. So this would just move into this category over here if you held these funds long enough in a taxable account. Don't worry about RSPs or TFSAs or any of that. But in the meantime, while you kind of wait for that, again, very, very tax efficient in that regard. I mean, if you have a growth strategy and you go to sell, it's like it's capital gains immediately. So at least this way you can kind of delay it a little bit, which is, hey, that's really helpful. So in my case, earning $100,000 on $4,131 of distributions, I would pay an extra $200 in taxes. It's basically, it's not real. It's a negligible amount of money, but hey, the more you make, and of course, the more taxable distributions you have, of course, that number is it will eventually move up, especially once that ROC transitions into capital gains. Understand that there was a lot there, so feel free to rewind and try to track with that again. But I also have a playlist that talks about taxes so that you can kind of get with this language a little bit more. I got to be quick just for the sake of the video. So for fact number 7, let's look at just a distinction between sectors. Which sectors have been doing better as an example, so you can do this for yourself if you have the tracker. So we're going to look at 2 of my favorite sectors, which is energy and utilities here in Canada. So in order to do that, what we want to do, head over to fund category. We want to clear everything out, and we want to type in utilities, hit enter. Then go energy, hit enter. So there we go. Now we want to filter A to Z. And then we get energy and utilities. Energy, utilities at the bottom. Now, let's just do this by total return. So we're going to want to highlight everything up to, I would say, right about there maybe. Probably want to go a little bit lower than that, I would imagine. Let's try this one more time. So we're going to go to, no, I guess right about there. So year to date, energy is up. Total return 5.16%. Energy's had a bit of a rocky road this year. Now we're going to look at utilities. What can we expect from utilities year to date total return? And it's up slightly below the S&P 500. It's up 14.23% as a sector on the Canadian cover call ETF AllStar Tracker tab. So that's one of the cool parts. I like to compare sectors. I mean, I think a kind of a fascinating one would be something like if we added, say, mining into it, right? If we added mining in there, what are we going to get? We got to go A to Z or A to... Okay, so there's the mining. We got CGF all the way down to AEME. Okay, so let's try that. Well, we're going to add in these ones. They probably are just going to blow everything else out of the water. And up, whoa, a staggering 56.9% total return year to date with all the various mining funds in there. So that's some incredible performance from the mining sector. And then, of course, utilities just doing its thing, being steady, getting some decent growth out of there as well. So now going on to fact number 8, which is looking at price performance. Now, it should always be said that in the world of investing, of course, we always want to talk about total return. I feel like I'm the only one that talks about the makeup of total return, which is distributions and price performance in one. It's combined. There's certain websites you go to where it only includes price performance and never the total return. So in this example, what I wanted to show was the funds that are basically made up more or have more of the heavy lifting has been done on the price performance side of that total return than the distribution side. Now, usually dealing with cover call ETFs, usually it's the opposite. It's a much smaller amount of price performance and a much larger share, which is income. But these are the top funds that we're going to filter here that have that price performance. So what do we got at the top of the heap? No doubt it's going to be a lot of single stock cover call ETFs. The idea here is the more concentrated you go down basically into an individual thing, and especially if you apply leverage to it, then you get the best outsized chance at bigger gains. So we see that with things like Palantir, and we see that with Broadcom. And then, of course, there's the gold producers. Of course, gold producers is going to be up there. And then we can compare it against its total return. So like, for instance, Palantir, up year to date on just price alone, 136%. Meanwhile, its distribution has led its total return to be 168%. So the distribution doing a smaller amount of the heavy lifting versus the price performance year to date. But you kind of get the idea with a lot of these funds. Even take something like gold producers, AMAX, 68%, and then another 10% is done with the distributions. Okay, so it's not true that income oriented ETFs, they lag on price and then the distributions themselves really have to make up. No, it like all things, there is a pendulum that swings. There are going to be funds that have a chance of getting their total return through the price. And then as you kind of wheedle your way through the scope of different funds, it starts to even out and then it starts to work in the other direction. More of the total return is naturally more in the distribution itself versus the price performance. Now, you often see this, or even in my personal experience, I see this more with diversified funds. You think of all-in-one funds like BMAX and HDIV and HDIF and HYLD and EQCL and QQCL and USCL. Like these kinds of funds have more of the total return coming through the distributions, but still they get some decent performance through through their price appreciation as well. So you kind of need to move through the list. So even take something like HDIV, like I had just mentioned. It's actually got some great price performance this year, and especially with total return, it's not equal. More of it's coming through the price, but it's getting much more closer to that equilibrium, especially as we move farther down. And then you kind of get into funds that, might be down price performance wise, but total return, it's up. So like, look at these funds that are in the red. The distribution's doing more of the heavy lifting to get these funds in the green. And so, I mean, think of funds like ENCL, which is a fund I have. Well, price performance wise, yeah, it's down, but its distribution is high enough that it's making up for it, and I'm getting, almost 11% with it. For our ninth set of facts, I want to look at two funds that represent sectors that have done really well this year, and one that has been just kind of muddling along, and that is things basically tied to gold, so gold miners versus healthcare. And we got two solid funds that represent both ends of the spectrum here in GLCC and HHL. So we have funds with fairly close yields, both under 10%. As far as performance is concerned, there couldn't be a starker difference between the two, with the healthcare fund just being trying to get up to 5% on the total return end, where GLCC is up 95% year to date. And then, of course, when it comes to fees, GLCC a little bit cheaper than the HHL. And then with distributions in there, this actually surprised me. HHL its first distribution was paid out in January of 2015. It's an older fund. You can see inception here was November 19th, 2014. Its lifetime change is 2.92%. Like, holding healthcare long term, the history is it does not treat this fund kindly when it comes to distribution increases. Typically, what you want to see is, if a fund grows, that its distribution can also grow with it. You want to see that history. If a fund has history and it's grown over a period of time, you would want to see the distribution follow suit with it, and it should. Whereas GLCC, it's been around even longer, 2011, but it has a lifetime change of 140%. That number seems much more in line. I mean, it's been around for 14 years. That's like an average of 10% a year for a distribution increase. Whereas this is like 0.2%, 0.3%, call it, since 2015. So it's just, those are some key points when it comes to your research to actually factor in, is that what is the lifetime change of distributions? Is it keeping up with say the 5-year performance, let's say? So if it's been around for a while, you would hope to see something more akin to this. Now, obviously, it got a pretty nice increase in this, actually at the right time this past month, where this jumped up 25%, but it could just as easily come back down. Just depends on the performance of the fund, the volatility, all kinds of other factors, but something to think about for your own research. For our 10th set of facts that we want to look at, it's the total lifetime changes in distributions. And as I had just mentioned with the previous 9th fact between GLCC and HHL, it is a good idea to, especially if you're using the tracker, look at filter this by lifetime change, and you can see there's a bunch of funds in here that have well over 100% in lifetime distribution changes, and then compare that against the performance of the fund over its lifetime. So if we take TLF, for example, .U, its lifetime distribution change is up 344%. So I'm kind of curious to see how it's overall. It's not showing here. That's too bad. But what else do we got? Maybe something like a more, let's try life. That's been around for a while, since 2017, up 162%. It is healthcare once again. So over a 5-year period, over 40%. And you get a much outsized distribution increase in that regard. So kind of nice to see that, where the lifetime change, at least we didn't see, the full history, but we got a taste that, hey, the lifetime distribution change is much higher than the actual performance of the fund lifetime. So kind of interesting just to compare the lifetime distribution changes versus the lifetime total return performance. What are some other funds that might be kind of fun to look at here? Let's maybe try HTA. This fund's been around for a while, 10 years, technology focused. What was the lifetime distribution change on it? 140%. Well, we can only go to a max of 5 years. We're not going to get that. But 3-year total return is up 110%. So I think either way, you're going to get something really good there as well. So just keep that in mind with the lifetime changes, everybody. Whoops, there we go. Something just to think about there. Total return performance versus the lifetime performance. And I mean, if there has been no growth from the lifetime change and distributions, but there has been price appreciation, I mean, that's just something to consider, especially if it has history. If it doesn't have a history of showing distribution increases, but the fund has grown, total return wise, that's a bit of a tip off for maybe a little bit of concern there, and maybe ask further questions. Hey, you can phone up these ETF fund providers, and I know that doesn't sound like something you can do, but you can absolutely do that. They have people that will talk to you investors regarding the history of some of these funds, some of these questions that you might feel like you need to bring up from videos like this. So that being said, that is all for when it comes to 10 high yielding income ETF facts regarding these covered call ETFs. So if you like what you saw, hit all the buttons of like and subscribe variety. I'll see you on the next video.